Hello class. During the last lecture, I promised that I'll give you feedback on quiz 1. I've already given you feedback on quiz 2 and I added that I'll give you the feedback on quiz 1 as well. So this video is to give you the feedback on quiz 1. In quiz 1, we dealt with IAS 21 and IAS 16 in the application of those two standards in one question. So for some of you, you had this question about the acquisition of equipment from a foreign supplier, which means it was imported. It was imported. And in addition to that, there were other costs that were incurred as well. And so you have to put the costs together and also then to identify the monetary items, and then you convert them and translate them at the end of the year. So that's what question 1 is about. Zonda acquires an item of equipment from a foreign supplier on credit. So we have payable for $6 million, 31st March 2020. And the exchange rate then was $1 to 8. And then there was legal and processing fees, transportation and installation, general stroke administrative overhead. So you know that in the acquisition of PPE, an item of property, plant and equipment, general overheads, administrative overheads do not form part of the cost unless you are specifically told that it's allocated to that item specifically, because so the general nature of it means it is not part of the cost of the item. Then there is the dismantling cost, because the estimated useful life of the equipment is 10 years and the entity has obligation to restore the location to its original state after usage. So there is dismantling cost involved. And you also know under IAS 16 that when an item affects the environment and the entity has obligation to restore, then we have to estimate the cost of that restoration and add it as part of the cost of the item. And so here we have the estimated cost of dismantling and restoration of 5 million and the cost of capital of 15. And remember, it is for 10 years. So you have to present value the 5 million. The present value, you have to present value the 5 million to at the discount of 15% and add it to the cost of the item. And the first requirement said calculate the cost of the item at inception 31st March 2020. So is the cost per the importation cost of 6 million translated at $1 equals 8 plus the legal plus the transportation plus installation. That's what will constitute the cost of the item. And so this is how it will play out. The cost 6 million by 8 will give you 48, the legal processing, transportation, and then the present value. The present value will give you 1236. And once you have present value, there will be unwounding. Once you calculate a present value of a future amount, then you must remember to unwound at the end of the year. So you remember there will be unwounding, and then it's an item of PPE, and therefore there will be depreciation also involved. So these are the things you have to bear in mind. So the cost of the asset is 54,236,000. So that's the cost of the asset. All right. Let's look at the B part. Prepare extracts from the financial statement. So there you have to remember you are preparing extract for statement of profit or loss and extract for statement of financial position. And therefore for the asset, you are going to think about the fact that you will have to depreciate the asset. So there will be depreciation. And then you also going to deal with the unwinding of the present value of the dismantling cost. So there will be a finance cost element also there for the statement of profit or loss. And we are dealing with IS 21. IS 21, when you account for foreign currency transactions, there will be exchange gain or loss once the rates are changing. So you have to deal with that in the profit or loss as well. So continuing this question, Zonda also sold goods to a foreign customer for 6 million on 30th April when the exchange rate was 1:8.5. You can see that the rate has changed. The customer paid 4 million immediately. On that day, Zonda paid half of the amount owed for the equipment. So the equipment was 6 million, they paid 3 million, and therefore there will be a balance of 3 million, which will now be translated at the closing rate. Now the year end, the exchange rate is 1:9, and then the entity's functional currency is Ghana cedi. So we have to prepare the extract. Okay, how would that look like? So to prepare the extract, you have a depreciation. Remember the cost of your asset, and your depreciation is from the date the asset is available for use. Let's check that. Although the equipment was available for use from 1st May, the entity did not bring it into use until 1st July. So your depreciation is from 1st May when it was available for use. So 1st May to December is May, June, July, August, September, October, November, December, which gives you 8 months depreciation. 8 months depreciation. So you can tell that we calculated depreciation for 8 months, and that is it. And then remember I told you about the finance cost, and it will also start from when you recognize the finance cost. Now we recognize the finance cost in March, the 31st March. 31st March, that's when. So for the finance cost is April, May, June, July, August, September, October, November, December. So that is for 9 months. That is for 9 months. So your finance cost is for 9 months. And then the net exchange loss will come from the other aspects. Now, again, your B part, extra from the financial statement, you have statement of financial position. You have the PPE at its carrying value. You have your receivable. We'll get to the receivable very soon. Receivable, because they sold goods and the customer paid part of it and part was left, and then there will be payable, the $3 million at 9 as your payable, and then the provision for dismantling will increase the liability, the opening liability plus the unwinding. Yeah, so that's your extract from the financial statement, just to show you a bit of working. So your plant is 48, your loss working on the payable, your loss on the payment is 1.5, because the plant came in at 8 cedis per dollar, but it was paid at 8.5. So there is an exchange difference there. And then at the end of the year, there will also be the translation of the balance of the payable, which is also the 3,000 at 9 compared to 3,000 at 8. So there is exchange difference of 1.5 loss and 3,000 loss. The 1,005 loss is on the payment, and the 3,000 is on the balance of the payable, the unpaid balance. So that gives you a total on the payable of 4,500 loss. In terms of receivable, we made sales. it came in at 8.5. The customer paid immediate at 8.5. So you can see there was no exchange gain or loss on the payment, because the day we sold the goods, they made the payment that day. So there is no exchange difference. But we will be left with a balance of 2 million at 9, which we will compare with the 8.5, and that gives us an exchange gain of 1,000. And so if you take out the gain of 1,000 from the loss of 4,500, then you are left with the net loss of 4,500. So that's how we got our net loss in the extract of the profit or loss. Net loss of here. Yeah. Okay. So that's about question 1, right? Want to keep it short, so I'll come back with question 2.